Welcome everybody. We have an awesome Tactical Tuesday tonight, and you're stuck with just me. Tiff's taking the night off tonight, but we're going to be talking about a really interesting topic, and that is mortgages. Something we all need, or we need to have, our partners need to have, or whoever we're working with, we need mortgages in order to qualify for investment real estate. So we're going to be talking to a couple experts tonight, mortgage brokers, people who are dealing with getting mortgages on a daily basis as their profession. So we're going to ask them some tougher questions. And if you guys have questions tonight too, throw them in the chat. And I can see we have some of you joining already. So say hi, let us know where you're from. And we're going to have a fun night tonight, guys, and interactive too. So as you know, if something is mentioned tonight when it comes to mortgages or interest rates or whatever it is we're talking about tonight, and you don't quite understand it, doesn't quite make full sense, throw your question in the chat. And don't be scared. Don't be afraid. Don't feel like there's a dumb question. Let us know, because we want this to be crystal clear for you, okay? And I know some that are watching have been investors for many years, and some of you are just getting going. And so the level of knowledge can be fairly broad, but we're going to try to make this as simple as possible tonight and get through some of the tougher things that are going on in our interest rate climate that we're living in our mortgage landscape that we have right now. So I see people all the way across the country joining us. So welcome, guys. It's going to be an interesting and educational night when it comes to talking about mortgages. And so we should get started. I'm going to introduce to you the two experts that we're going to be interviewing tonight. One is Shaune Impey, and many of you know Shaune. He's been around. We've interviewed him before. He's been in the investor circles for quite some time. He is an investor himself, and that's really what's so important about our team members that we use on our team, our mortgage brokers, our lawyers, our real estate agents, whatever it might be. We want them to be investors as well, so that they understand the lingo and they understand the strategies that we're trying to implement. And so that's exactly what Shaune is. He's an investor himself and a mortgage broker, been doing it for a number of years. The second person we're going to introduce to you is Shaune Sullivan, and he as well is an investor himself. And super important that whoever you deal with is an investor themselves. And so Shaune Sullivan, he's actually one of our Ignited members as well. So he is right in the know when it comes to working with investors and getting mortgages for investors. So yeah. All right. Well, there we go. I see a lot of stuff happening in the chat. So guys, questions in the chat, comments in the chat. Let's get this chat moving today so that we have a lot of action going on there. Okay. So let's bring on our two Shaunes. So we have Shaune Impey and we have Shaune Sullivan. Welcome, guys.
Hey, how are you?
Pretty good. I'll just remove that for a little
bit. Thanks for the invite, Corey.
Absolutely. And you heard the introduction, and I know you guys will live up to it. You are experts when it comes to mortgages, when it comes to working with investors in particular. Let's just start there, because this is something that always comes up. It doesn't matter what profession we're interviewing. Guys, give me your quick opinion. How important is it that the mortgage broker that an investor works with, how important is it that they are an investor themselves? Do you think that plays into choosing your mortgage broker? What would you say, Shaune Sullivan?
I would say for sure it does. You don't want to have somebody who doesn't necessarily know what's going on be the person who's helping you to find a mortgage. There are so many different programs out there that if they're not involved in it themselves, they're not going to know, and they're not going to necessarily be able to help you and get you the right mortgage for your property.
Yeah. Anything to add to that, Shaune Impey?
Sure. Been there, done that. So I have lots of properties, and I've had lots of different mortgages over the years, some really cheap rates, some expensive rates. And when I started, 6% was a great rate. So I don't get too upset when I see them in the 4.5%, 5% range, because I know what they were like in the old days.
Yeah. Yeah, I agree 100%. We told this story a couple weeks ago on our live that, the first mortgage Tiffany and I ever signed off on, we were getting what we thought was an amazing deal, and it was for the time, and it was at 6.7%. And I'll never forget thinking how great of an interest rate that was, because most people at the time were getting, between 7 and 8 or up to 9%, and we got something under 7%, and we were so happy. So yes, it's all about perspective when it comes to interest rates, and so we're going to be getting into that. And so for everybody listening, we're going to be talking about interest rates and how this affects us as investors, but we're going to be talking about a lot of other things too, such as how can you become I get a little feedback from one of you, so maybe I'm not sure which one, maybe Shaune, I don't know if that's true, but maybe you could, unless you have
background noise from where we're at here.
Okay. Yeah, Shaune is joining us from the airport in Vancouver right now. So again, thank you for doing that, Shaune. But yeah, I forget where I was going with that, but let's forget that and move on. So let's go when it comes to interest rates and the changes that you have seen over the last year. Let's just kind of recap this, guys. Let's recap. 1 year ago today, so let's go back to September 2021. What would you say were the average interest rates you were seeing then? And what would you say are the average interest rates? And I know that this can be, it depends on the client, and it depends on what they're buying, and it depends on so many different things. But if you were to just put an average number a year ago and an average number now, what numbers would you throw out, Shaune Impey?
3%.
3% a year ago?
No, 3% increase.
3% increase. Okay. So the average mortgage that was being signed a year ago was what? What interest rate roughly?
1.75 to 2.
Okay. So let's say a year ago you were getting 2% interest rates, and now we're looking around 5% interest rates, or 4.5, 5, somewhere in that range. So it's a significant increase that we've seen over the last year, and that concerns a lot of investors, especially investors that have really gotten into investing in the last year or the last 2 years. Now they're starting to see interest rates go up where we haven't seen this in a number of years. Do you have a word of advice, Shaune Impey? Let's start with you, because you've been around a long time. When investors start to see all of these interest rates going up, do you have a word of advice for them?
I suggest they Google Bank of Canada rates, and they can see the graphs going back 25, 30, 40 years. We're back to when they were in the 18% range. And every time there's a sharp run up and a spike, there's invariably a drop off. So, and that drop off is, sometimes it's within a year or two, sometimes it's 3 or 4 years, but generally they go back to where they've been. So, I've been pushing variable for investment properties quite a bit because a number of reasons, penalties and easy to get out of, and generally variable's been a better choice over the long run.
Okay. Now you mentioned something there, Shaune, and I'm just going to expand on that a little bit, because I'm in the same position as you. I would say every mortgage we have over the last 15 years, we have always followed the variable rate. We have always had a variable rate mortgage. And like you said, there's a couple reasons for that. Number one, we never know when a partner needs out. We never know when we want to sell a property. We don't want to be locked in and have to pay high payout penalties. So and plus, over the last number of years that we've been investing, variable rate has always been slightly less than the fixed rate. Would you say that is changing? Would you say that maybe some investors should be looking at fixed rates? Or what type of investors would you suggest look at fixed rates versus variable? Or do you think variable is still the best to stick with?
I would say nervous investors should go to fixed.
Okay.
You can't stomach the up and downs, or you can't handle the change in payments, then maybe fixed is where to look at. And today, the variable rates and the fixed rates are pretty much the same, which is a change. You always used to, be 3/4 of a point or a point cheaper on the variable rate mortgages, but that's not the case here, where the Bank of Canada has kind of given us one in the butt here the last little while, and may do it again in October and December when they have the next two announcements.
Yeah, absolutely. Shaune Sullivan, what do you think? I don't know what you personally do for your mortgages or what you generally recommend, variable or fixed, but where would the decision lie for an investor, whether they choose a variable or a fixed, in your opinion?
For me, it's going to be about how long they're going to keep the asset for. Right now, it's hard for people to cash flow in their properties. If you got something in March when the rates were around 2%. Sorry, this time last year rates were about 1.8 in a variable. You'd be paying $2,100 on a $500,000 mortgage. Now that same mortgage is about $2,800.
Okay.
So there's quite a bit of change in your interest costs at that point in time. So depending on your property and what you're planning on doing with it, I would look at that first. If you think that you need to get out, then I would, like Shaune said, I would say definitely in a variable, because you can break it with your 3 months penalty. But in a climate where the interest rates are rising, if you're trying to break a fix, the penalty is going to be very big.
Yeah, absolutely.
If rates go down in the future, 2 or 3 years, they drop back down again, you will have a huge penalty on a fixed, 5% down to 3%. So
yeah, I remember, and our mortgages, I'm just thinking of a couple examples. This was back in like 2012, 2013, somewhere in there. We had a couple of mortgages that we were thinking of refinancing, that sort of thing, but they were locked in, and they were locked in for 5 years. And I think we were 2 years into them, that sort of idea. And I think we were paying somewhere in the sixes as far as interest at the time. But we looked to look at the payroll penalty, and these mortgages were only around $200,000 each, and the payroll penalty on them was $16,000. So that's a significant payout penalty and takes a big chunk. If you're looking to refinance something, that takes a chunk out of the money that you might end up getting. Payout penalty could be a big factor as to whether somebody chooses variable or chooses fixed. So I like that. So for those of you that are listening, there's a couple things you got to keep in mind that we're hearing here. Yes, if you are nervous and you like to know exactly what your payment is going to be for the next 1 year, 3 years, 5 years, 10 years, whatever it might be, then we would go with a fixed. If you're willing to stomach it, and like Shaune mentioned, on a $500,000 mortgage, $2,100 to $2,800, that's a $700 increase. What we've seen in the last year, that's a significant amount, and that's a big chunk of cash flow that could come out somebody's portfolio in one property, with the variable rate going up if you're on variable. So you've got to be able to stomach those things if you're willing, if you're going to keep going as far as variable is concerned. So, okay.
One more thing I can add to that, Corey, is there's a simple little formula you can use if you want to know where your rates are going to go. So the rule is, for every 1% increase in the rate, it costs you $50 per 100,000.
Okay.
So if we've gone up 3%, so you'd multiply 3 times 50, so it'd be $150 for every $100,000 in mortgage you got. That's how much your payment is going up. So
okay, perfect.
$100,000 is a $600 increase. So if you are thinking where rates might go up another 1% or 2%, you can figure out what your payment's going to be pretty easily.
Okay, awesome. No, that's great. Okay, so guys, we can keep that little rule in mind. So maybe somebody can throw that in the chat just so that we have that rule as a reminder. So for every 1% it goes up, of every $100,000 of a mortgage we might have, it's a $50 increase, $50 a month increase. Is that it?
Yeah.
Okay, perfect. Awesome. That's a good little rule of thumb that we can keep in mind. Awesome. Okay, guys. So next question, moving a little bit on from interest rates to a new topic when it comes to mortgages. Are you seeing the mortgage landscape as a whole opening up a little bit for investors or closing down a little bit for investors? Is it easier, or are there more products to qualify on today than there were a year ago, or are there less? In your mind, what would you say? Let's start with Shaune Sullivan.
I'm going to say that there's a little bit less with all of the other stuff that the government's talking about. They're still trying to tighten some money up. I've had some conversations this past week with some lenders, and they've told me that the bank regulator has come to them and told them that they have to take some products off the shelf because they didn't want them available to the market anymore. So I can see that they're going to be tightening it and making it a little bit harder for us.
Okay. Shaune, Impey, anything to add to that?
Yeah, once COVID hit, there was a few lenders who tightened up. Ones who used to do rentals in Alberta, some of them have cut back or eliminated rentals in Alberta. Or Scotia, for instance, used to do 5, now they do 3. Lenders who used to do holdcos, there used to be quite a few in our channel. Now it's down to basically 1 or 2 that do holdcos. So it has tightened up. And
okay, so the fact that interest rates are going up, mortgages are harder to qualify for. Let's talk about the next thing, and that is the stress test. And maybe for somebody who has never heard of what the stress test is, Shaune Sullivan, how do you define what the stress test is?
Yeah, basically the stress test is you're going to add 2% to whatever the rate is that you're getting for your contract for your mortgage, and then you have to qualify at that income level for how much you can qualify for.
Okay, so let's say I'm going to get a mortgage at 5%. I have to be able to qualify to pay the payment at 7% in order to be able to qualify. So that's what the stress test is. Every bank out there, is it like a kind of a law that every bank has to use a stress test, or do some not use it?
No, some cannot. That's where you get into like B type of lending. But anybody who is an A lender, who's regulated by the federal regulator, they have to use the stress test. Okay.
Shaune, Impey, since the interest rates have gone up, and I think we just answered this question, but I'm just going to clarify again. So the interest rates went from, let's say we already talked about 2% to 5%. The stress test is 2% above that. So a year ago, we were looking at having to qualify based on a 4% interest rate. But now, since interest rates have gone up 3%, we're on average having to qualify at a 7% interest rate. Am I on the right track here, Shaune Impey?
Well, almost correct. So the stress test was in that ranging about 4.75, and the last was 5.25. So the rule was you had to qualify at the stress test or contract rate plus 2%, whichever was more. So there was occasions where people were getting mortgages in the high 2s, and the mortgage stress test was 5.25. So you were actually you could be 2.5 or 3% over the contract rate, but you have to be at least 2% over there. So they haven't changed the stress; it's still 5.25, but that's the actual rate these days. So it really doesn't mean anything, and changing it isn't going to make any difference. They're just going straight to contract plus 2%.
Yeah. Okay. Awesome. I love it. How you guys have clarified that. Because a lot of these questions that I have down here, I don't really know the answer to as well. So I want to get some clarity on this kind of stuff as well. So from what I've heard so far, let's just recap. Interest rates are going up. It's less products out there to necessarily qualify an investor on. The stress test has also gone up. So, the properties that we could have paid for or bought before, we now have a little bit of a limit, a higher. The value of what we can buy has come down. We can't buy as much as we used to based on the stress test. I just want to tell everybody who's listening here, this goes to show why you need to be working with a mortgage advisor, a mortgage broker that works with investors, that understands this stuff, that does this on a daily basis, versus maybe going to your bank, or versus maybe just going to where you've always gone for a mortgage. But using a qualified professional like one of our Shaunes here today can make a big difference on what you're able to do if you want.
I have another little formula for qualification there. So
Thank you.
every 1% increase in the rate knocks about 9% off your qualification. So
Okay.
So if you could afford a $500,000 mortgage, take 9% off that, you're down to the 450, 455 range. So with a 3% increase, that's 27%. So even around 25% knocks a quarter of what you could qualify for off the
That's
mortgage. Again, if you went to your mortgage broker early this spring and got qualified for X amount of money, when you go back to him, he's going to just take a pair of scissors and cut about a third of that.
Okay. Okay. All right. So here's the thing, guys, is, for somebody that's listening right now, they might be saying, oh my goodness, this is depressing. All I'm hearing is bad news. It's harder to qualify. I can't get as much. The interest rates are higher. My cash flow is less. Like, what is good with all of this? Would you say there's a silver lining in here anywhere for us as investors with everything that's going on? Would you say that there's some sort of opportunity that maybe opens up from all of this, from your perspective? Either one of you, Shaunes.
Yeah, so I'll go. So with the interest rates going up, the prices are coming down. So you're going to get a smaller mortgage amount is going to be smaller. So even though your payments might be the same or maybe a little bit higher, you actually owe less. So your pay down will occur faster.
Okay.
What you pay in more in interest, you may recoup in equity appreciation on your property. So, and if you could buy a property and make it work today, and say you are in a variable mortgage, and 2 years from now rates back off a little bit, well then you're gonna, with a caveat, you're gonna have more cash flow, right? So there's two types of variables out there: adjustable and true variables. So the payments are different depending on which one you get.
Okay, and we're going to talk about that in a quick second here. I'm glad you brought that up. That's a nice little segue. But absolutely, and I want everyone that's listening to understand this, to hear this clearly, that anything that happens, whether we have market changes, whether we have interest rate changes, whether we have mortgage lending changes, whether there's rent increases or decreases, all of these things that happen to us as investors, some of them we can control, some of them we can't. But when these things happen, a window of opportunity of some sort does open. It doesn't matter which way it goes. We just have to find it. Where is the window in our current climate now? Where is there opportunity in the current climate that we're living in? And there always is. And I love what you said there, Shaune, Impey, on if we're able to cash flow on a property now, and maybe some are listening are saying, well, I can't find any. But if we're able to find one and buy one and cash flow now, imagine how good it will be if and when the interest rates do decrease. Then that would be a phenomenal property at that point. So these tests, as much as we don't like them and they do lessen what we can qualify for, they are a protection for us at the same time. And down the road, if we know we can make those payments and if we know that our rent can cover them anyways, even if interest rates do go up, we're going to be less stressed. So there is a little bit of a silver lining there too.
Yeah, and when people can't afford to buy, they got to rent. So if there's more renters and less buyers, you'd think rents have to go up a little bit. We've seen that in Edmonton. Rents are starting to sneak up, and properties I've got are gone up $100 or $150 for some of the units there. So it softens the blow a little bit.
Absolutely.
Mm.
Absolutely. Okay, guys, that's awesome. So let's go back to a comment you made a little earlier, Shaune, Impey, and that was about the different types of variable mortgages, because we've had a couple questions in Fearless, and with variable rates changing, some people's payments have changed and some people's payments have not changed. And I think that has to do with the type of variable mortgage they might have. So maybe if you can just explain the difference between the two mortgages, so that we can understand why some payments are changing and why some aren't.
Okay, so the misnomer that happens out there is banks and people tend to call everything a variable rate mortgage. Well, there's also it's called an adjustable rate mortgage. So in an adjustable rate mortgage, every time the Bank of Canada changes the rate and the bank goes ahead and changes their prime rate, then your payment changes up or down. Okay, so if it goes up 1%, and you got $100,000 mortgage, you'll be paying an extra $50 on your mortgage.
Okay.
The other one, on a true variable rate mortgage, the payment stays fixed. So if you have a $1,000 payment on your mortgage, that payment stays fixed with the caveat that until you reach what they call a threshold rate. If your payment doesn't cover the interest on the payment, then they're gonna raise your rate. So in small increases up and down, your payment doesn't change. So it helps if you've got rental properties and you know you're always going to be paying $1,000, and if rates go up half a point and down a quarter, you don't have a different payment every month. It stays constant. What changes is the amount that goes towards interest and principal changes, because the rates go up and you don't pay any more, but you got more interest. That means less of your principal is getting paid down. So the closer you get to that threshold rate, the closer you get to almost like an interest-only mortgage. So cash flow is better, but you're not making the money on the back end on the mortgage pay downs. Robbing Peter to pay Paul.
Yeah. Okay. So good question. Jules just put in the chat here. Is it harder to qualify for a true variable or versus the adjustable? Or is the qualification for both of them the same?
No different.
No different. Okay.
Same mortgage.
Okay, perfect. So that explains why. So it's almost like if you have a true variable mortgage and the payment is somewhat fixed, at what point, so how many percent up would that have to go before maybe your payment ends up changing? Or the bank says, is there a certain amount where let's say it goes up 3% or 4%, 5%? Is there at some point where the bank says, listen, we have to make an adjustment here, we have to change your payment? Where does that go?
So that's what Shaune called the threshold earlier, the threshold point, or if you're reading the news, they call it the trigger point, because I think it's a little more flashy to grab some headlines. But that happens when basically, like Shaune just said, when you're just paying interest and no principal. At that point in time, the bank will reach out to you and say, you need to increase your payment so that you can offset that, so that you can pay some of the principal, because it's against the law to not pay any principal on a traditional mortgage like that. So you have to.
Yeah, you can figure out your threshold rate pretty easy. Just take whatever your payment is times 12, and that's how much you're paying for the year, and divide it by your mortgage balance, and you'll know that whether if it was 100% interest, that's what your rate would have to be. So,
right. Okay. No, that makes sense. Okay.
It sounds geeky because I do all that kind of stuff.
Another Shaune formula. There we go. Okay. Excellent. So that makes sense, and I like it. So, and you know what? Just for those out there listening who are maybe hearing this for the first time, you can have a true variable rate mortgage. You have a fixed payment, and for the most part, that it's kind of like having a fixed payment. For those that can't stomach it going up and down, it's kind of like having a fixed payment. It's just that you're not paying down much principal, and that's the difference between the two. So you can still have a variable rate mortgage and have a fixed payment without it changing every single time. And that's called a true variable. Do all banks offer both of these? Like, can you if when someone's qualifying, can they say, well, I prefer the adjustable or I prefer the true variable? Do all banks offer both?
Well, Scotia does adjustable. TD does
just adjustable. That's it.
Yeah, and TD does variable. The other banks not in our channel, RBC, CIBC, and BMO, offer variable, I believe. All the monoline lenders out there like MCAP and First National, people might be familiar with, they're all adjustable rate mortgages.
Okay.
Credit unions are kind of all over the map there. So.
Right. Okay. Awesome.
Apparently, a variable interest mortgage is about 10% of all the mortgages out there. And when it comes to like a floating point mortgage, true variables are only about 10% of all the mortgages out there. So it's not very popular.
Okay. All right, good. Okay, well, thanks guys for answering that, clarifying that. So let's move on to a slightly different topic, obviously still to do with mortgages, but I know you guys also deal with private mortgages on, a one-to-one basis with somebody, either a lender or with a borrower, and you help to arrange that kind of stuff as well. So, have you seen a correlation? Okay, with regular interest rates have gone up. Have you seen when it comes to private lending interest rates also gone up the same or more or less, or what? When it comes to private mortgages?
The people who are funding it from a HELOC and that, I mean, obviously the spread has dropped quite a bit. So they're looking to get more money. I haven't seen as much of a rise in the people with cash. Like, I know you're going to talk about this later, like RSP money or TFSA money or something like that. They're looking for a net return on their money, and depends what else is out there in the market. So I think the people borrowing from their HELOC are getting squeezed a little bit because the other lenders aren't jumping up as much as they would like to get their spread back up.
Yeah, the mortgage investment corporations that I've been seeing rates from, they're pretty consistent and haven't changed very much in the last 6 or 8 months. It's because of where they get their money from, right? People invest with them and then they expect a rate of return. So as long as they're bringing that return in, they don't necessarily have to raise the rates all that much.
Okay, interesting. I like that answer. So if the money's coming from an RSP, if the money's coming from cash, the rates really haven't changed a whole lot. If somebody is borrowing funds, and for those that are listening to this and don't quite understand, let's say I have a line of credit and it's $100,000 and I pay 6% interest on my line of credit when I take that money out. I could take that money out of my HELOC and say, hey, Shaune, find me somebody that wants to, that will pay me 10% on that money. And then now I'm making 4% on the bank's money, a 4% spread. But if interest rates go up on my HELOC, then obviously I need to make more money for this to be worth it. So I can see how that would reflect. Anything to add to that, Shaune, Impey?
Well, if you were, you could lend your money at a variable rate as well at prime plus something to your client if you're in a HELOC or something like that, just like a bank, or there's a few MIP type lenders out there that base their rates on Bank of Canada or a lender, like some of them are owned by the big banks or got involvement from the big banks, so they do lend it. And because the Bank of Canada rate was so steady for so long, people thought they were really getting a fixed rate mortgage when really they had a variable rate mortgage. Just that they were short term and nothing really happened in the 6 or 12 months that they had their mortgage rates didn't change because Canada rate didn't change.
Yeah. Okay. So a couple questions in the chat here. One, are you able to change from variable to adjustable without penalties? I would assume that just means if the bank offers both. It kind of sounds like they offer one or the other, but how would you answer that? Am I correct?
You're correct.
That's correct.
Yeah. Okay. So it's one or the other. Wouldn't be easy to change. You'd have to be paying out one and getting a new one somewhere else, I think, something like that. I wonder what the minimum would be to get into hard money lending. If somebody wanted to lend out their money, what minimums would you guys say there is?
I would say that if you anything less than 50 is really tough. And the reason is that when you go to factor in the legal fees and all the costs and stuff doing that, the 10% that you're giving to your borrower, when you start putting all the fees and legals in there, now that 10% turns into 20%. And when you fill out the disclosure documents and everything else here we have to do in Alberta, they say, holy crap, I thought I was getting 10% money and now it's 20%. Just the way we have to factor all those into what's called the APR. So
yeah,
I never lend any private deals. I never make it less than a 1-year term just to get the max amortization of it.
Yeah.
So,
okay.
If you're gonna do, team up with somebody and have $100,000 or $150,000.
Makes sense. The more money you have, the less those fees become a percent of, and it makes more sense. So hopefully that answers that question. Grant is asking, do you have a tool or a spreadsheet to compare fixed versus variable mortgages, where you can kind of adjust the variable at set points and see how it impacts your principal and interest? Would that just be a regular mortgage calculator, or would you say there's some other tool that you use? Shaune,
I don't have an all-in-one tool for that. No.
Okay.
I think what you just said, Corey, is probably the right thing. You just run it through a couple of different calculators and plug it into Excel yourself.
Okay.
No matter what calculations you do on the spreadsheet, it always requires you to enter in your guesses, right? So you're guessing when you can put in. There are spreadsheets out there, and I don't use them, but you can say what happens if the rate goes up 0.5% every year, every 6 months, and it'll tell you all the changes and stuff. But I rely on my formulas and just kind of tell people where they tend to go. So you're getting really deep into the weeds to the second decimal place for guessing at where interest rates are going. So it doesn't make a lot of sense to me.
Yeah. Okay, good. I'm not sure who it is, but somebody here is asking, there's no way to get the borrower to pay these fees. Well, yes, the borrower is the one that pays those fees, but then the borrower does pay
the fees.
Yeah, the borrower is the one that pays the fees. Exactly. But that's what Shaune was saying about going from 10%. Now it's 20% if it's a low amount. So, okay. So I'll just address this question, or where would be the best place to meet these people? So let's say someone has 50 grand, someone else has 100 grand. They want to team up for lending or to real estate purchase. I'm going to answer that question by saying the best place to meet these people is here in Fearless, guys. The best place to meet these people is at our upcoming boot camp, which I'm going to talk about a little bit later, which is on October 21, 22, and 24. And that link will be shared here in the chat. This is a place where there's going to be hundreds of investors gathered together that are going to be learning about how to raise capital, learning about how to do partnerships, learning about how to buy investment real estate, especially if you're just starting. That is exactly the best place to meet these people. So let's see. Love this topic. There we go. Fearless Bootcamp. That's right, guys. Okay, next question. And I didn't hear about this until this morning. Tiffany told me that there's been some changes when it comes to Olympia Trust or trust companies and dealing with RRSP funds, RRSP mortgages. It used to be I could draft a mortgage and I could do all of the work and go to Olympia and register it on title myself and do all of this stuff myself if I wanted to borrow somebody's RRSPs. But I've heard that this has changed, and now a mortgage broker or somebody else needs to be involved in this transaction. Is that correct? Let's go with Shaune. Impey. Are you now dealing with Olympia Trust mortgages, RRSP mortgages, where you didn't have to before?
They made a rule that you need to have a mortgage administrator if it's what they call a syndicated mortgage, which is more than one lender. Yeah, and I think, Shaune, you're in Ontario, right?
Yep.
You're not? Yeah.
So, yeah,
they
Ontario-
actually have in Ontario, they have a position called a mortgage administrator. In Alberta, there's no such thing. I phoned the RECA guy after I heard this about it and said, what's a mortgage administrator? How do you get to be one? He says, I'm not sure what you're talking about. This is the head guy at RECA in licensing, so it doesn't exist here. But it's more people who are in the private mortgage world, like the Cedar Peaks and people like that. They're a mortgage administrator, but it adds 1% or 2% on, and it's getting pretty dicey for any broker to do syndicated mortgages through Olympia and that, because you're really not allowed to do that. So
Okay.
So you have to have one person, or if it's.
So a syndicated mortgage is when you have like 5 people coming together on the exact same mortgage. If you took those same people and you had 5 different sets of terms and they were all in different positions, so first, second, third, fourth, and fifth, then you wouldn't necessarily need to have an administrator. But it's when you're grouping everybody onto the exact same mortgage and then everybody has to get treated equally and fairly. That's where you need the administrator. So they need to make sure that everything is being done above board. The regulator here in Ontario changed the rules last year, and that's why Olympia changed them. Could have been this year, but that's why Olympia changed the rules.
Okay, so a mortgage administrator is different than a mortgage broker, is what I'm hearing.
Separate license in Ontario, yes, and there's big fees with that. It's a bit there would be like a monthly administration fee on top of the actual fee to set it up. So it's not something that you would do if you're buying like a $400,000 duplex. It's more something where you're talking like really big money, multi-million-dollar type of deals.
Okay, and this is only if there's more than one party involved. Otherwise, you can still just people can still borrow RSPs from somebody else. But if there's, go ahead, Shaune Sullivan.
Yeah, no, if there's pooling, if you're going to pool a bunch of people together, then that's where you need to have that administrator.
Sorry, I got a dirt bike going by here. Okay, yeah. Awesome. Okay, no, that's great. Thank you for clarifying that.
If you and your buddies want to throw your money in the pot and have one guy be on the mortgage and you borrowed it from them somehow, then as long as there's only one name on the mortgage, we can do it as mortgage brokers. Okay. Generally, and even Olympia probably won't ask for an administrator on one person, but there's no way to hide the combination of funds though through Olympians.
Yeah. Okay. Awesome. Thank you, guys. Now, I have a question for both of you, and I'd like to get each of your response to this. And this comes down to, this was a question that I got asked when I was a realtor and working with investors. I had a couple of different investors. I worked with literally hundreds and hundreds of different clients, but there were a handful that asked me this question, and I thought that it was a great question to ask. And I ask this now of the people that I work with. So if somebody wanted to become your client, how would you describe, now, other than somebody who can qualify for 1 million mortgages, how would you describe your perfect client? How could somebody become a great client on Shaune Impey or Shaune Sullivan's list of clients? How would you describe that person? Let's start with Shaune.
Sorry, start with me, you said?
Yeah.
Well, the first thing I would like to see clients do is if you ask them for documents, they don't say, why do you need that? I need it because I need some scrap paper for my kid to color on. No, I need it because the bank is going to ask for lots of documents. Now, they may not ask for every single thing that I ask from you. Depends on the file and how it turns out. I can't tell that till I have everything, right? And I get surprised sometimes when people, don't send me certain docs, and usually they're trying to keep something from me. So number one is somebody who's, got all their docs lined up and in good shape and stuff like that. So presentable forms. So that makes a good client. And someone who's going to tell you everything they got, what their plans are. And as an investor, you can, I tell people this doesn't look like a deal. Like I don't want to give you a mortgage on a property. You're going to lose money on this thing, I think, or you're going to do a renovation and you've got a $40,000 budget to put in a basement suite and fix the upstairs, like give your head a shake. It's $120,000 to do that, so help them out on that side. So someone who's willing to listen and doesn't, quote and know everything. So,
yeah. Okay.
Two of the biggest things for me. So.
Awesome. So for everybody listening, I want you to be taking these notes down, because we all need mortgage brokers. We all need professionals to be on our team. And that's actually one of the topics that we talk about in our boot camp is building our team and quarterbacking your team. And so we want to be, Shaune Impey's best client. We want to be Shaune Sullivan's favorite client. We want them to be working hard on our behalf, not getting annoyed with us because we ask, why do you need this paperwork, or why do you need that? And we want to be prepared, have our docs in a row. If he says, I need these 10 documents, I'm just guessing here, Shaune, but I would assume you'd prefer somebody sent them all in one email versus 10 separate emails over a 10-day period. So that it's easy for you to track all of this stuff. And if you're looking for something, you can find it easily. Okay, Shaune Sullivan, what would you say? Is there anything different you would add to that?
I'm actually just going to steal 3 of Tiffany's favorite words, and that's know, like, and trust. I have to know the person. I have to know what they're after. I have to know what their goals are. We have to like each other so that we can make sure that we can work together. And I have to trust that the documents that they're giving to me are legitimate and not fraudulent or anything like that. Anybody who can come to me and give me those things the same way as I would offer as myself as a joint venture partner, that person would be a fantastic client. Yeah,
I love it. Know, like, and trust. Super important. You want to be able to, one of the things I never liked was when somebody was just kind of not telling me the full story, if something was a little shady or something was a little off, we don't want to be that person. And we talk about that all the time here in our Tactical Tuesdays and at our boot camp about being good humans and how important that is in this business. We want our team members to trust us. We want to be able to tell them, this is my plan. This is what I'm trying to do. We don't need to be hiding things from anybody. Looks like we lost Shaune. Oh, he's coming back. Okay, so these are all important things. So I hope that those of you that are listening can take note of that, because we want these people on our side when it comes to getting mortgages for us. Okay, so that's kind of the questions that I had for you guys tonight. Anything else you wanted to add, or anything you think that would help an investor in this mortgage climate we're living in that maybe I missed? Oh, Shaune Impey, you are muted. So maybe we'll get Shaune Sullivan to start. And Shaune, is there anything that you'd like to add?
Just really, when you're ready to get going, make sure that you have all your ducks in a row. Sit with somebody and chat. Let's see what we can do up front. Don't go out and grab a deal and then try and figure out how to make it fit into what's going on with you. That's always the best place to start. Okay.
Awesome. Appreciate it. And for everybody that is watching and you want to get a hold of Shaune Sullivan, his email is on the bottom, Shaune@approvedfinancial.ca. Shaune is also all over social media. So just look for Shaune Sullivan on social media. And he said that's one of the best ways to get a hold of him as well. Okay. So there we go. That's awesome. So anything else you wanted to add, Shaune Impey?
Get yourself pre-approved from your broker so you know what you're looking for. So a common question I get is, well, how much can I afford for a rental property? And I say, well, that depends, because you haven't told me whether this is a $500,000 property with $2,000 in rents or $4,000 in rents. And that's the difference between qualifying and not qualifying. So I have a little spreadsheet I set up that I send out to people, and I say, based on the value of the property and all your other information, here's how much rent you need for that property to buy it, because the rent is offset against the cost, right? So if it's a $300,000 property and you need $3,000 of rent to qualify for it. In Alberta, you're not going to get $3,000 on the 300. But if you only need $1,500, well, that's a good chance you'll get it. So that makes it a lot easier for people. I said, if you're looking at property, figure out what the rents, and if it's way less than what I tell you, then there's no sense us chasing afterwards.
Yeah. Okay.
Yeah.
Awesome.
So just track me down at ShauneImpey.com, and we can.
There we go. Shaune Impey, for anyone that wants to get a hold of Shaune Impey, Shaune@mymortgageline.ca, or go to ShauneImpey.com. And you can have a conversation, like he talked about. Getting pre-approved with your mortgage broker is super valuable. So give either of these guys a call. Anybody that is looking for mortgages, these are your two guys here in Canada. Shaune Sullivan is out in Ontario, and Shaune Impey is in Alberta. But I'm pretty sure that both of you kind of do mortgages across the country. So it's not where the mortgage broker is located that's important. It's where the property is located, but they cover our country.
Definitely the property. It's getting harder to go cross-border sometimes. Here, getting some rules tightened up. So I do most in Alberta. I do some Ontario deals and some BC deals. So.
Okay.
And
okay.
I don't like to use the word pre-approved. I use pre-qualified.
Right. Yes, absolutely. That's a better word. Love it. Okay, well, I appreciate it, guys. Thank you for joining us today. Thank you for giving us some awesome answers to some easy questions, some tougher questions, clarifying things, and also making it very easy to understand, so not complicating it. I know Shaune Sullivan, I was talking a little bit earlier before we went live, everybody, and he was like, should we be talking about this and this and this? I didn't even know what he was talking about. So I'm like, no, absolutely not. We need to keep this simple. And you guys did an amazing job at that. So I know you're just joking, Shaune Sullivan, but yes.
All right, I got a plane to catch. I better run.
Okay. All right. Take
Good
care.
timing.
Okay. Thanks for
Thanks,
coming.
guys. Yeah.
Thank you.
There we go, guys. We just spent an hour with a couple of mortgage brokers, asking them some easy questions, some difficult questions, and hopefully you got some value out of that. And you saw their contact information. I'll put it up one more time if you want to contact either one of them. Their email is here on the banner. And I also wanted to say, guys, that we have, and we announced it briefly last week, but we actually have our early bird registration is open for our upcoming boot camp. It is October 21st and 22nd. That's a Friday evening from 7 to 9 p.m. Eastern, and a Saturday from 11 a.m. to 6 p.m. Eastern. That's October 21st and 22nd. So mark those dates off, scratch them off right now. And early bird registration is only $27. Julie put it in the chat a little earlier, and it's probably going to be coming again soon. Join us in boot camp. This is an amazing opportunity to be able to network. We'll be doing breakout rooms. We're going to be meeting other investors. You're going to be putting certain things into practice during boot camp that will blow your mind when it comes to investing here in real estate and opening up different channels that you never saw before. That's what our boot camp is all about. And one reminder, guys, is we will be giving away a free scholarship at our boot camp to our Ignited program. So that is of a lot of value. It's a 1-year, 12-month membership into our Ignited program that we will be giving to one of our lucky boot campers. So join us in boot camp, guys. You have until October 4th. That's 1 week from today. Next Tuesday, our early bird registration closes, and we go back to our regular price. So if you are going to join us now anyways. It's $27. I know that we also have a special, we're doing something different that we've never done before. Okay. So for those of you that are listening, if you have a friend that you want to refer to our boot camp, have them, when they are registering, put your name in the registration form. We have a spot on our registration form, who referred you. Okay. So if you refer your friends, if you refer your family, if you refer somebody that you think would find value in being a part of our boot camp, then we are going to be keeping track of those referrals. Okay. Whoever, we're giving an Amazon Kindle away, a Kindle reader, and we have a whole bunch of other prizes that we are deciding on this week that we are going to be giving away to who refers the most into our boot camp. So if you want a free Amazon Kindle, if you want some other free swag that we're going to be giving away, just send out a referral and have them in the registration form, put your name down as the one who referred them, and we will be keeping track of that. And we have a lot of prizes we're going to be giving away this boot camp. All throughout boot camp, we're going to be giving away prizes for those who referred others. We're going to be giving away prizes for those who are commenting the most. We're going to be giving away prizes, like I mentioned, our scholarship as well. So we have a lot of different prizes that are going to be a lot of fun and excitement that we're looking forward to in our new boot camp too. So it's going to be fun, guys. $27. It's super cheap. We're only having it. We're not doing that to make money. We're doing that because those who pay attention, and we want all of you to pay attention at this boot camp. If you have been to one of them before, you know what it's all about. But every boot camp is different because the people in there are different. And so we invite you back and you're going to have a lot of fun. So that's it for tonight, guys. Our time is up. Thank you for joining us. And we will see you next week with another Tactical Tuesday. And we will see all of our Igniteds over in our laser session here in about 4 minutes. So looking forward to seeing you guys there. We got a couple cool questions and a pitch practice. So we're looking forward to that. We will see our Igniteds here right away. But thanks for joining us, guys. Have a great evening. And we'll see you next week.